Yeah, so the first question in this set is, which is a barrier to the integration of sustainable finance and investment strategies in your institution's business activities? All right, so I think we can clearly see that the lack of clear, harmonized definition of taxonomies and sustainable finance is one of the dominating themes which has been covered, and we'll continue to cover that. Could you perhaps move on to the next question, please? What would be a major impact on your institution for integrating sustainable finance? So that impacts your investor base, the resilience of the business, the profitability, or is it looked at merely from a reputational perspective? Great, resilience indeed. Great. I think there is a third question, which perhaps we can move on to. So the final question is, which of the ESG factors are currently given priority at your institution's activities? So the environmental factors, social governance, are equal importance, being split amongst the three. Okay, interesting. This is really interesting, and I think we have a balance in the answers here. Thank you so much for participating in this poll. So we will pick up the conversation, and particularly, I'll pick something up from the question that was asked, and we saw that majority is looking at the resilience of the business as one of the impacts. And even when we look, at this final question, we see that governance plays at least an equal role as all the other factors. And Haytham, while you were speaking, on some of the trends in Qatar, Giaco, you were nodding with approval, particularly around the governance development and the social aspects. Now, you have done a lot of work, particularly in the IPO markets in the region, and you have advised many clients, around that journey. So could you please walk us through the main elements that are being looked at when, for any of the, be it corporates or financial institutions, if they're going to the market, what are things that need to be taken into consideration, and what are the pain points that are typically faced by clients?
So, I sit in the Capital Markets Advisory team at HSBC, and we've with a particular focus on the equity capital market side. And what we've seen over the last 18 months is a particular focus by investors on ESG issues for companies. And the more IPOs come through, especially in this region, as you know, this year, I think some of the biggest IPO markets in the world have been the United Arab Emirates and Saudi Arabia. So there's been a lot of examples that we've seen. And ESG questions are coming from not just global investors, but regional investors as well. And part of this is that investors for a long time have had ESG integrated into their investment decision-making and into their fundamental analysis of a company's value. The United Nations Principles of Responsible Investing has been around for over a decade. It's got thousands of signatories of investors with over 120 trillion in asset under management. These investors essentially promise that they will integrate ESG into investment decisions. But what's really happened in the last 12 to 18 months is the number of investors who have signed net zero ambitions. So as investors and banks have signed these commitments on net zero, they need to look at their financed or invested emissions. That means the emissions of the corporates that are going to IPO or the corporates that they've invested in, their emissions are now being counted as the bank's or investors' emissions. So for instance, HSBC, we made a commitment to be net zero in 2020, October. It took us up till February this year to measure our Scope 3 emissions for just two sectors, oil and gas and power and utilities. It will take us and other banks a couple more years to measure what our financed emissions are for all other sectors. And we're looking at, this year we're going to look at, for instance, cement, steel, aluminium, and aviation and automobile sectors. Then the following year, look at commercial and residential real estate and agriculture. It takes a lot of time for banks and investors to actually measure their emissions. And so what we've seen during the IPO process is investors are asking these questions. So for the first time, companies that are looking to come to the market, they have to have an answer to investors on what their emissions are. As you can imagine, a lot of private sector companies have not done any ESG reporting, let alone measured their carbon emissions. But these questions are coming. Investors are asking, what is your decarbonization plan? For certain sectors, what is your health and safety management system? What is the lost time to injury frequency rate for your employees? What are you doing for your contractors and subcontractors? It's not just the decarbonization, but other ESG issues which are taking more and more seriously now. And we're seeing the questions. And part of our role is to support our clients in ensuring that disclosures are in place and they're meeting the expectations of investors on these issues.
Thank you, Giacomo. And also I think part of the disclosure, or one of the challenges within the disclosures that are expected from institution, is the accuracy of data. And obviously, particularly when it comes to carbon footprints and emissions, data plays an extremely important role. Alex, I'll turn again back to you. And you guys do provide partially or maybe holistically a solution to that. So could you please talk to us about how are you helping corporates and financial institutions to capture that data set, particularly around scope 1, 2, 3 emissions, and how that can help them from their own disclosure perspective?
Okay, so sustainability reporting is becoming mainstream. It will be the same as financial reporting. There's no way of avoiding it. Now everyone has to prepare, whether you're a large corporate or an SME. The large corporates already have IoT sensors, different instruments to measure these emissions. They report in their ERP systems, and that's then fed in this reporting software. For the SMEs, it's expensive to put this in place, and so what could be done are proxies. So with process engineering, you estimate, based on your services and products, what are your GHG emissions, and that is your best estimate. Now, as these technologies are becoming more and more common and cheaper, we can expect that in 5-10 years, SMEs will also have the means to use this type of technology and report the exact GHG emissions and any other ESG data that need to be submitted. On the financial sector side, the key problem is having access to the data. So if you're a bank, credit institution, you need to interact with your counterparties, corporate, retail loans, thousands, millions of loans sometimes. It's quite complex. So what do? One suggestion we have, well, first of all, we also provide proxies to these banks, but most importantly, we help them interact with the counterparties. And because we have this infrastructure where we have multiple banks connecting, we enable a corporate not to do the exercise 5 times by going to each single bank. They do it once, and the data is available to all the banks. So that's also avoiding duplication of work, mutualizing efforts, reducing the costs. And at the end of the day, this is a utility infrastructure. ESG data should be at cost. The same for asset managers, same logic. You have to screen your portfolio of investees. When it comes to listed companies, the data providers out there do cover these companies. But what about the private companies and the SMEs if you're a private equity or a VC fund? That is quite complex to get. And again, you have to perform due diligence. So why systematically perform this due diligence? Let's use digital tools to vulgarize, democratize sustainability reporting and making sure all this data flows. Today we have a taxonomy as the basis. We're going to cover other taxonomies, other frameworks, but we're at a paradigm at the very beginning of the next 30 years to reach this climate zero status.
Great, thank you. A lot of ESG data, I think one of the larger consumers of these ESG data would still remain within the financial services industry. And Hussam, I'll move on, I'll ask you a question, and I'll go back to something that you mentioned earlier, that, banks are not solely responsible for the development of the sector. There needs to be specialized institutions, but throughout the lack of existence of some of these specialized institutions, there is still some level of expectations for banks to play that role. Now, We know that, you're sitting at S&P ESG Solutions. You work with financial institutions within the region. So what would you think, or from your experience, what are, some of the challenges that financial institutions face while they want to integrate and implement their ESG or sustainability strategies?
I mean, banks and financial institutions are probably the most influential after governments and regulators, because they finance every project there. There's got a bank or a few banks involved, investors. Banks, they put a price to risk. They assess, they discuss with decision makers in companies. They influence those companies. They can direct how companies behave in a certain way. And hence, in that sense, banks are very influential. But in order to exert that level of influence, it's important to have that level of clarity and disclosure. I mean, when we worked with SMEs, for example, you mentioned SMEs, Alex. SMEs, they just want to get on with if they're in a manufacturing company, they want to get on with their manufacturing. They want to get on with supplying to their network. They want to get on with their business as usual. So how could financial institutions help that is by assisting them understand their impact, whether it's carbon footprint, whether it's their ESG scoring. How do you score as a small company? How is your performance? What's your impact on the environment? That will be something, when you speak about innovation here, financial institutions can innovate in that aspect. We tried that in my previous company, and one of the challenges we faced was the access to data. How do we help those companies in different sectors understand the impact through data? And then how do we facilitate that access? And I think this is something that I'm working with my colleagues now in S&P to see how data can be used by financial institutions to leverage and implement better products. I mean, let's not call them green, let's just call them better products, or products that will have a way to measure impact, have a way to assess whether it's carbon footprint, whether it's the other aspects of interaction with the environment. And I think these are the next stage of product development. Let's not get involved now in the greenwashing and washing, because that's inevitable. But one way to get out of that is to not look after the labels, but to look after the actual data that will help financial institutions understand, assess. There are methodologies in place that can help them build those products, have better clarity on their portfolio. How are they performing as a portfolio? Understanding the risks associated with different sectors, different geographies, different countries, different assets. All of that is now work in progress, and financial institutions can get involved in developing that because this is the way forward, I believe.
Great, thank you, Hussam. So I think I've gotten an indication on timing, so we'll squeeze in one final question very quickly.
Sorry, I just want to add.
Oh yeah, sure,
one thing
go ahead.
to Hussam. I think it's always a conflict between financial institutions and regulations and commitment. So this is something that honestly cannot be resolved except by regulations. Because today what was mentioned on SMEs, definitely SMEs are not willing to pay the extra cost to comply, which means that they will struggle. On one of the charts, profitability was the lowest voting, which I disagree with because it has to be the balance. So ESG is excellent, but it has to be driven by regulations, not by initiatives. Today, everything is being driven by initiative. So we need to have, similar to investing in fixed income, for example, it's driven by regulation by the central banks. They will tell you if the rating is X, you take X provisions. And financial institutions have to understand it like that. Otherwise, it will continue to be an elective initiative, which only banks or financial institutions who are willing to take the extra cost are willing to commit to that. So I don't know if I'm right, but this is the crux of the matter. We need the regulators to help us with that.
I think it's many factors. Regulation, the role of products that banks build, interaction with the customers and SMEs. I mean, SMEs are the ones that pay the price eventually. And I remember this in my previous country when I was working. There was cancellation of contracts by buyers from developed countries. And the suppliers are small SMEs because they're not complying with expectations. Contracts cancelled. There were some media reports and there were some issues with buying products from that country because SMEs are not understanding exactly what needs to be done. And then you say, well, you know, who's responsible for this? The government alone, the banks alone, the SMEs themselves, the buyers. It's a collaborative effort, but there needs to be a foundation of understanding. People and banks and financial institutions and regulators need to have a common ground understanding.
Which is an imposed law.
Great. I'm really excited to see this, picking up. But I will take, for the final question, I'll pick it up from there, and I'll quote something that our CEO, Mr. Yusuf Al-Jada, mentioned during his opening remarks, that the overall development, particularly from an environmental and social perspective, is shared responsibility between the private and the public sector. Now, we spoke about the financial institutions, we spoke about the regulators, we spoke about the technology and how it impacts in that. One final question, Hussein, I will turn to you. What do you believe the role of the state-owned entities and the large corporates in the development of the sector?
Actually, I will start from where it was ended to answer the question.
Go ahead.
At the end of the day, I'm sure we have risk teams from different banks probably here. At the end, they will be looking at the P&L, right? And whether this cash flow of the company is sustainable enough for the debt, whether it's compliant with the ESG or not, still they will look at that. So I think the oil and gas sector and the financial institution, I would agree that these are the largest two sectors here in Qatar. So I think the way it works is allocating capital to basically establish foundations to develop the ESG compliant companies in the country. Otherwise, it's very challenging. The private sector would be taking the hit and the cost, and you wouldn't see a support from banks like Haytham was highlighting. So it's a bit challenging for the private sector to comply with the ESG, and there is no even subsidy on the additional cost that they need to follow.
Thank you, Hussein. So to sum it up really, really quickly, in the interest of time, so we need to look into regulations, the role of tech into the development, subsidies and incentives for the private sector. And obviously we can sit here and talk about this all day, but unfortunately we have to move on. So I'd like to thank the esteemed panel for their thoughts and for taking the time and sharing the stage with us. And we wish you the good of the rest of the day. Thank you.
Thank you, gentlemen, for sharing your take on the sustainable and green financing solutions of the future. Slight change of agenda. We'll have the prayer and coffee break now. So I'll see you guys back here in 30 minutes. So I'll see you here back at 12:40.